I'm Scott Starratt with Starratt Wealth Management at Canaccord Genuity Wealth Management. Last time we chatted, the discussion was around what was going to happen in the US election, both the presidential and the Senate. As it turns out, although it was quite close, and although Trump hasn't officially conceded yet, it appears as though Biden is the winner. And it also appears that the Senate will remain in the hands of the Republicans. Although there's a runoff election on January 5th, the Republicans would have to lose both Georgia seats in order for the Democrats to take control. The markets quite like this, primarily because it meant that Biden's agenda, which some would term to be progressive or socialist, was probably not going to get enacted as fast as what Biden and his team had hoped. Things like tax cuts, changes to regulations, those type of items, we're probably going to be pushed down the road now and aren't going to be a 2020 or 2021 issue. So if you recall, at the end of October, the markets had dropped quite significantly going into the end of the month, primarily because of the concern with the election. Now that that concern is out of the way, there's definitely a more risk-on type of atmosphere where people are back to buying stocks again. Definitely the buying of stocks has been helped by the fact that there's at least 2 or 3 different vaccines that appear to be quite effective. Although the likelihood of you and I getting the vaccines in the next month or 2 is unlikely, it definitely sets some optimism for early 2021. One thing that the markets may be discounting or not paying as much attention to right now is the fact that there's still a big surge throughout the world in coronavirus infections, and that has led to definitely more people in hospitals all across North America. So the fact of regional lockdowns or countrywide lockdowns, although they're still on the table, they definitely aren't going to have maybe the same impact as they did in March, but we could definitely see the volatility in the stock markets increasing or staying really where it is right now, which is quite volatile over the next few months. I think when we look at the portfolio positioning as we stand right now, we continue to be slightly underweight equities. That being said, our recent moves to ensuring that our equity managers are doing their job, our market managers are doing their job so far, now granted it's only been a few weeks, but so far has been very, very good. We really like the fact that these managers are participating in more of the upside of the market, and that translates, even though we may be underweight market in the portfolios, it does definitely translate into better returns for clients. And definitely, we're seeing, even though September and October were down months, granted not as down as the market itself, but still small down months, we're definitely seeing that November seems to be a big increase so far, although there's definitely still a few days left before the end of the month. Before year end, one of the things we're focused on is finishing our allocations to ensure that portfolios are properly balanced in the way that we like them. We're definitely ready through cash and with safer investments to take advantage of the volatility if it does hit during December, January, or February. And finally, we're looking at, and we're just starting to look at year-end items such as tax situations. Are people going to have to take money out of their RSPs or RIFs in order to reduce or not pay as much tax as they might in later years? Or in a situation where people will be sitting with big gains or losses, that we can offset those gains and losses by some portfolio activities. We'll be in touch with everyone before the end of the year to kind of chat about that and just to confirm that everything's in really good shape and that there shouldn't be too many changes necessary in the portfolios. The other thing we're really focused on this year going into year end is ensuring that we do have the ability to, like I said, take advantage of opportunities if they do come about. We're hoping that the volatility will allow us 1 or 2 entry points over the next few months so that we can ensure that we're taking advantage of these opportunities. One of the other things we're definitely looking at in portfolios is ensuring that income is still high, and for people that need the income. That continues to be a struggle. And why I say it's a struggle is when you look at the interest rates out there today, they really haven't changed that much. I think back in the early fall, the 10-year US bond was trading at about 0.6% per year for 10 years. Now we're up to a whopping 0.88% per year for 10 years. Again, interest rates incredibly low. That being said, it's interesting to note that the bond composite, which is measured by MSCI, has actually dropped for the last 3 months ending the end of October by 1.57%. And you'd say, well, why would the bonds drop? Well, primarily it's because the interest rates have gone up. And like I said, the interest rates only went from 0.66 to 0.88. But that small little increase meant that the bond aggregate as a total, measured by a total of bonds in the market, is down 1.57%. So you can imagine what the effect would be if people end up wanting to, or sorry, if the interest rates end up going higher, that people will have a struggle paying their debts. But not only that, there definitely could be effects on the bond market, with only a 0.22% increase in the 10-year bond, meaning that 1.57% drop. So this is one of the reasons why we don't feel that investing in a lot of government debt right now makes a lot of sense. We're trying to find income from alternative means. That's, in some cases, long-short credit. These are managers that are able to protect on the downside. They also can take advantage of expensive bonds and bet against them. But they can also take advantage of bonds that they feel are cheap and that offer really good interest rates going forward. We also have a component of private debt in the portfolio, which has done quite well throughout this period of time. Definitely helped by the fact that governments continue to spend money. And that doesn't look like it's ending anytime soon. Some of the articles I've read in Bloomberg have indicated that there's about $5.5 trillion of money printed this year so far. And that just gets added to this huge amount of debt that's out there in the global companies, or sorry, global sovereigns, so country debt. And I think going forward, we're going to end up in a situation where interest rates have to stay low for an extended period of time, and really probably aren't going to go up until inflation starts to really increase. And that we'll have to deal with that at the time. It probably doesn't end well, but I think this is a situation that's a few years out and shouldn't happen in 21 or 2022. That being said, we're prepared for the eventuality that something like that does happen. The portfolios are protected against that for the most part, and we would just continue to focus on ensuring that the assets maintain their reasonable price in the portfolio, and that we don't get too overweight one particular idea or one particular investment. So that's it for now. As we go into the US Thanksgiving Day holiday, we are expecting markets to slow down a bit and maybe pick up towards the middle of December. As always, if you do have any questions, please do reach out to Jim, myself, Angela, or Heng Yi to chat with us, whether it's something administrative or something going on in the investment side of the portfolios. We're more than happy to talk. Also, as I continue to say, a lot of times in these little chats, feel free to send this to family or friends that may or may not be getting good professional advice from their own advisor. We're more than happy to sit down with them and have a coffee and discuss with them what our philosophy is, and if we can make any small suggestions to their portfolios that might help them moving forward.